Hi, this is Albert Yu of the Albert and Gloria Yu real estate team at locationfirst.ca. Today I want to define or go over some terms that frequently come up when you talk about mortgages. For instance, the word term itself, amortization period, payment frequency, closed versus open mortgages, as well as fixed versus variable, as well as prepayment privileges. For instance, when we talk about payment times or payment frequency, you can either pay off your mortgage monthly, semi-monthly, weekly, and bi-weekly accelerated. The standard is monthly, but if you want to pay off your mortgage faster, which means you pay less interest over time, the best thing to do is something called bi-weekly accelerated, which is different than just bi-weekly non-accelerated. Also, when it comes to mortgages, you're going to often hear the word amortization period and term. Amortization period defines the total amount of time it's going to take to pay off your mortgage. The standard is 25 years, but you can choose any period you want. And also the maximum period right now is 30 years. However, if you do a 30-year amortization period, there is a premium of 0.2% of your mortgage. So keep that in mind. Term is basically how long certain parts of that contract are going to be valid for. So for instance, if you have a mortgage right now with Scotiabank, you're only obligated to use Scotiabank for that term, and that term could be 1 year, 2, 3, 4, 5. I've seen up to 10 years, but basically at the end of every term you can renegotiate with the current bank, or you can take your mortgage somewhere else. So term is very important to keep in mind. There's also the word closed versus open mortgages. So most mortgages are closed, meaning if you won the lottery and you wanted to pay off your mortgage, you wouldn't be able to do so because the bank would charge you a prepayment penalty. And the penalty is either 3 months interest, which is very little possibly, or it could be the interest rate differential, which can be quite costly. So it's very important that you figure out how your bank calculates a prepayment penalty. Mind you, if you have an open mortgage, that means you can pay off the mortgage at any time you want. You still have regular payments to make, but let's say you did win the lottery or if you inherit a large sum of money, you can pay off the mortgage without penalty. Now, you might be wondering, why doesn't everyone just do an open mortgage? Well, most banks realize that open mortgage is not advantageous to them because it's not set, meaning you can pay it off anytime, and the banks make money by us paying off their interest. So therefore, banks usually charge a higher interest rate for an open mortgage. And because most people don't plan on winning the lottery or don't plan on getting a big inheritance, a closed mortgage is more than fine. Also, keep in mind, most mortgages, closed mortgages, have prepayment privileges. So even though you can't pay off the entire mortgage balance at any point in time without penalty, most banks will allow you to pay off a certain percentage without penalty, and they call these prepayment privileges. So most banks will give you 10% of the balance every calendar year or every mortgage calendar year, or they can give you 15%. I've seen up to 25% as well. So that's something to keep in mind when you talk to your mortgage representative, is ask them what are the prepayment privileges. Finally, we come to the word, fixed versus variable rate mortgage. Fixed basically means for the term, your mortgage rate will stay the same, your interest rate will stay the same. Variable means that your mortgage rate or your interest rate will vary every time, could vary every time the Bank of Canada meets. The fixed mortgage rates are based on the Canada bond yields, so it's kind of like a stock. You know, if there's a lot of demand, then the prices will go up and therefore interest rates will go down. But the variable interest rate is really based on the Bank of Canada. And the Bank of Canada meets about every 6 to 8 weeks to determine how the economy is doing. So if they think there's lots of inflation, the economy is growing too fast, they're going to increase their rates to the banks. They call it the overnight lending rate, which means the banks will then increase their prime rate, which will then affect the variable rate mortgages. Depending on where variable rate mortgages are, you can usually get a discount. So right now, variable rate mortgage is prime less a discount of, let's say, 0.85%. So those are just some simple things to keep in mind when you're talking about mortgages. We went over, payment frequency, term, amortization period, closed versus open, as well as fixed versus variable rate mortgages or variable rate interest rates.